Let's talk more. Okay, John Burns, research and
Totally.
consulting, because we have a lot to get through today, Matt.
I can make this as quick as we need to be.
Where are we in the housing cycle? 2025 edition.
Yeah, so this article lays out the premise that there are these phases of housing development, and you can. I'd love to get your insight here after I run down these and how it relates to this overall kind of idea of business cycles. But as this article lays it out, the housing cycle progresses from the bottom of the market to recovering, to growing, and then you plateau, and then it's a slowing market, and then it's a falling market, and then you're back to the bottom again, just kind of in a neat little circle here. At the bottom, you have distressed capital investing, low volumes, weak pricing, and recovering as demand stabilizes and pricing environment is improving, and then things improve until you get to a plateau where things are starting to fall, and then you fall, and then you're bottom again. I kind of flew through those, but you kind of get the idea. I do think that there is some assumption here that that the conditions of one of these phases automatically flow into the next. But that's a discussion I'll save for just a little bit. I am curious, Spencer. We spoke about this a little bit before the episode about how this may relate to business cycles and the idea of cycles in general, and because some of the assumptions in here are like the way that I understood this, and I watched a video that they had connected.
Yeah.
They had a 2008 video where two houses were talking to each other, and a grandfatherly house was talking to a child house and saying like, "It's okay, little guy, you'll get sold soon." And I was like, all right, that was funny. But yeah, how does it relate to the idea of business cycles and debt cycles? And like, am I missing something here by assuming that this cycle just flows in a perfect circle all the time?
Yeah, so I think that's the fallacy in that it's not like a perfect cycle. It's not a perfect sine wave.
Yeah.
If you're looking at like cycles or waves, if you look at like an audio source, of a sound, if you look at
Yeah.
it, you spin it around the computer and you look at all like the waveforms, there's a lot of different, the line going up is like positive voltage, and it goes down, it's negative voltage. There's a lot of they're not perfect sine waves.
Yeah.
There's cycles within cycles, periods within those cycles, and because there's can be a lot of different things going on in a system.
Yeah.
So business cycles are used to try to understand the path of the economy, looking at the past and identifying that there are different cycles.
Booms and busts.
Exactly, it's a
I
boom
get
and
it.
bust, and so this was like the predominant way of looking at like the economy, kind of especially like in the early 20th century, and especially kind of leading in and just after like the Great Depression. And it was later that like the Chicago School really was started focusing more on the money supply, the monetary system, as being a major contributor. But similar as we're going to talk throughout the episode of, what's the primary driver here? Like we're going to talk later about, is it employment growth? Is it supply? They're both important, but some can be more pronounced and have a higher impact. And it's the same thing with different cycles. There are debt cycles, there are real estate cycles, there's the general business cycle, and these cycles can have different lengths and period lengths. And so like the real estate cycle, is thought to be, and again, it all changes and averages, and again, it's a soft science, right?
Yeah. No.
But the real estate cycle is typically longer than like the stock market cycle, or even like the general cycle of the economy.
Are you talking about on a national level or on a market level?
But all of that,
Because
national level. So there are, so every city, every market, every submarket, you could track a cycle, and all those cycles are interdependent.
Yeah.
They influence each other. They can also have independent drivers. Like for example, a submarket or in a suburb of a major city, if it has a ton of growth, that growth will have effects on those other markets. It will have its own cycle. It could be on a period of growth, whereas the neighborhood just miles away could be on the decline.
Yeah.
But then in the combination of those two affect the broader cycle of that larger MSA. Same that MSA going into a state, a region, a country, continent, and then the world. They all affect each other.
Yeah.
And so similarly, there is a general real estate cycle and a rent growth cycle, And there are smaller cycles within that. Outside this like 25-year real estate cycle, we have annual cycles. We have, leasing season and slow season, like the leasing season basically starts in March and goes through July.
Yeah.
And then it gets slow like every single year. And so there are other longer term cycles than that. So
they kind of it does kind of illuminate things for me, because the way that I understood this initially, at least when it comes to individual markets, is kind of what our colleague Jay, the head of
it's our chief investment officer.
I'm sorry, but he talked about student housing, how the cycles there is like a bunch of rents will go. There's a scarcity, housing or apartment scarcity. They will all descend. A bunch of builders will descend on that market, build a bunch, and then now there's a glut, and then that glut will persist for a while, and then no one will build for a while, and then now we've got a scarcity again. Then they'll build again. That's kind of how I understood it in simplistic terms. I think that but now what informs me on the national level is the debt market. So the debt can be good debt or bad debt, and they'll want to build when interest rates are lower. And I think that that's what happened in the last couple of years, and that's why I think this chart is a little bit weird to me and harder for me to understand, because some of these markets, all of these markets follow the debt. They all built more when they could, and now they're building a little bit less. Now,
debt, and also the money supply. Also, how much actual money is in the system? That's where like the Chicago school came into place with Milton Friedman. Post Great Depression, really understood it's not just the business cycle. We have to look at the money in the system.
Okay, and what I'm positing here, and maybe can kind of correct me if I'm wrong, but I think some of these cities have faster cycles. Maybe some are slower cycles. Maybe a place like Phoenix is more reactive. Their highs are highs, their lows are lowers.
100%.
And on the other hand, there are some, I think, and we've kind of been making this point about like Midwestern markets where they don't maybe they don't get to the plateau stage even. Maybe they just stick around in the recovering and growing stage for a much longer time, and they may skip the falling or bottoming because they've just been so steady the whole time. I think so. That's my point, is like the stages, whether you reach all of them, that may not work on the individual market level. However, I do think that it makes total sense on a national level. Right now, we are just like on the other side of like an oversupply of apartments. So that's something that's experienced throughout the nation.
So just in apartments, we have this larger supply wave that's affecting different markets differently, but most markets to some degree, but then those individual markets have their own individual growth story that influences that. And so it's all relative, but you can paint a larger narrative that can be somewhat accurate, but then the more granular you get, you can find very different stories. And just again, that's why it's important to not just understand the market, but the sub-market, but then even going in more granular at times of like neighborhood by neighborhood or block by block.
Yeah.
Because I mean in Indianapolis, what's the cycle of Washington Street, or Washington Boulevard versus like Crittenden, Boulevard.
Oh yeah,
it's like, these streets are on different trajectories, and they're like not too far away from each other.
Yeah.
And Crittenden's a fine road.
55th and Guilford's a lot different than 59th and Guilford or 57th and Guilford.
Yeah, exactly. But it's true.
Yeah.
So, but in trying to have an awareness of these cycles and kind of where they are. Now, one question I had though for you, man, I don't know if you had this or found it or if they've got it on here. I was curious at looking at this chart that they put out last year.
No, I didn't look about. Yeah, that would be interesting to see if things have progressed. I know that other places have employed that, like the cycle schema to these two different markets and to the apartment market. I just didn't. Yeah,
I think John Burns does one every year.
Okay,
and so that'd be interesting to look on at the next.
If I can find it, I'll put it in the notes too.
Yeah,
for this
perfect.
One.
Because like I think they had like Indianapolis on the plateauing or slowing. Last year, and so then it slipped back because it's all of a sudden you get some new information. So it's not perfect because these are all like interpretations, and someone is not an expert in all these markets,
Yeah.
and they're having to use they're looking at data
Yeah.
that could be not even like fully correct.
Take Phoenix, for example. I don't know about the rent growth. Now, this may apply to the housing market in general, too, and I'm sure certainly it does.
Yeah.
But, like, if you're talking about apartments, I'm not sure if Phoenix is at the recovering stage. Maybe it is. And what is recovering? Demand stabilizing, pricing environment firming. I think that there's still a ways to go, if you slice it and look at different ways, and if you look at the, apartment supply, especially in some of these. But
Yeah.
who knows?